How's it going?
Good. How are you?
Good, good. So yeah, sorry for the late start here. We'll kick it off with you. If you could give your rundown, and then we'll switch over to Adam.
Cool.
Second. Ian, can you hear me?
Yeah, I can hear you. Can you hear me?
Okay. Yeah, I can hear you now.
Cool. All right. Good deal.
Yeah, go for it.
Sounds good. Well, good to see everybody today. Val, can we share everybody else who's in attendance?
Yeah, I don't know why it's not. It's like different this time. It's not showing everybody. I don't know how to do that.
That's okay. I
Yeah.
can I can do a quick intro here, real quick while we get going. Ian Nichols, Director of Advisory Services for the Western Region for Red Cedar Advisory Services. We do accounting and finance for sponsors so they can focus on executing on their deal. So like our target and our ideal client is like has raised 10 million in equity, hasn't raised 250 million in equity. And like I said, we do all the back of the house work so they can go execute on their business plan. So thanks for having me today.
Yeah. No, thanks for coming on. Yeah, go for it. So who's your ideal client?
Yeah. So ideal client is a sponsor that has, maybe done deals with a bigger institution before, or, is a part of a bigger shop and then has maybe moved on to do their own kind of business plan. So has a track record, has a niche in whatever, multifamily industrial, we've got kind of all the gamuts of commercial real estate. But maybe the client has moved on to do their own deal. And so we will help them do the finance and accounting for the entire transaction from acquisition. Really, it's Val is helping the client with the underwriting on the front side. And then once they're in business mode, we help do the accounting and finance. Also, we can help do construction draws, close on the acquisition, stuff like that. But I can talk about some things real quickly I've seen in the market over like the last, I guess, couple weeks that might be interesting to kind of kick the conversation off is like Q1 was pretty active in new fund starts and whatnot, and then it got kind of quiet. I would say after Q1, like I think there was some exuberance in the market of, Trump is in the office and kind of riding the coattails of the election, and then it got kind of quiet. But I have seen in the last like 60 days, we've seen deals transacting now, and I would say the theme is like off market is the theme, is what we're seeing right now. And also, so those are deals that never even got to the market. It's basically word of mouth from buyer to seller. And then also that the regional banks are back in business. I've had two deals recently. One was with First Bank here in Colorado, and one was with Academy Bank in Missouri. So interesting that they were quiet for what seems like the last 24 months, and then they're kind of back in the market. So so that's what we're seeing. And then one of those deals is a multifamily. I would say it was a neglected multifamily in the Kansas City, Missouri area. And it's going to be a major lift, remodel, renovation. And then the one here in Colorado is a former Safeway box turned into a national fitness use.
Cool. Yeah, I mean, we've seen similar trends. First quarter was really, really busy. And then I think in March, things kind of like with the tariff news, everything kind of slowed down a bit. And now we're seeing kind of a pickup again.
Yep. And then I guess I will say, it sounds like Tax Cuts and Jobs Act 2.0. I'm like literally following minute by minute on the Wall Street Journal, but like it seems like it's got legs right now, and that might also kind of pick up the momentum. With bringing back bonus depreciation. There's some talk about doing OZs over again. Just some of the benefits that we got from the 2017 Tax Cuts and Jobs Act, I hope is going to propel us through the rest of the year. So.
Cool. Great. Yeah. Anything else to share before we hand it off?
I think that's good for now.
Okay.
But appreciate you guys inviting me.
Yeah. So ideally, it's a sponsor who's going from transaction one-offs to creating an actual fund, and then you all can help with the accounting side on.
That's correct. And yeah, we'll do single asset syndications or funds,
Okay.
It's really more about does the sponsor have a track record that we can kind of get behind, is sophisticated and kind of knows what they're doing. Like that's where we want to, play. Both Mike and I, who's my partner, we came from a public accounting background and have been in the commercial real estate industry for the last 10 years, both of us. So we kind of have that institutional knowledge. We're trying to help, transfer the institutional processes down to the smaller owner, operator, developer, syndicator, or fund, fundraiser. So
cool. Sounds good. Well, thanks for joining. We're going to move over to Adam Eloise. Let's see.
You guys hear me?
Yeah, I can hear you.
Oh man, I don't know what it was.
All good.
I'm better at the debt placement than I am technology, so happy to be here. So I guess when we had talked before, Val, you wanted me to share a little bit about, I guess, like the company and kind of what we're seeing on the industrial space. So president of Pine and P Capital, we're a commercial mortgage banking firm here in Denver. Probably about half our business is done here in Colorado, and the other half is kind of national. We have a national platform, so we work with your traditional bank, credit unions, life insurance companies, alternative financiers, CMBS. We do some agency stuff as well, but that's not necessarily for this call. Happy to share a couple deals that we're working on, and then the specific capital partners that we're using. So on the industrial side, we have a value add project that we recently placed in Brighton. So the lift was four units, two of them being already leased, the other two vacant. We kind of underwrote that with 12 months, or we actually got 18 months interest only. So it was a 5-year term, 18-month interest only, 25-year amortization with a burn off. And that was with a traditional lender here in town. So all that to be said, that there is traditional debt, both bank and credit union, whether it be, local, national, super regional, that are very interested in this asset class. Leverage on that deal, and that was, on the sponsor, was 65%, right? Deals are underwriting just kind of your fairway stuff, probably around 65 or 70%. And that's going to be sized on a 125 debt service coverage ratio, right? Traditional debt is pricing, and we'll just use like the 5-year, just give some context, probably 220 to 300 over the corresponding treasury for more mini permanent debt. We're actually doing some construction as well, so that's a good piece to be able to share, because for the past 18 months we really hadn't done a lot of development because things weren't sizing out for developers, which I'm sure a majority of people on this call can echo as well, right? But I think that there's some people that are hedging the market a little bit now. Pricing is going to be a little bit more in line with where things need to be to kind of get that green light, and developers are having more of a reasonable return characteristic, right? I mean, we all got pretty spoiled for the past 10 years, right? And things were, it was difficult to make things fail. But anyway, all that to be said, is there are lenders that are doing that. That's going to be based on SOFR, probably between like 300 and probably 250 to 4, depending on how much leverage you want on the traditional kind of bank side. A lot of life or credit unions aren't necessarily looking for that type of lift right now. from the construction perspective. They're going to be a little bit more fairway. And then from a life company perspective, we have about 30 correspondents that we work with. We have a project in Boulder right now. It is a credit deal. Give you a little more context. Two buildings totaling, 50,000 square feet. Long-term leases. So we have a life co that is pricing that deal 140 over the corresponding treasury. So that's going to be, look what the debt markets are, 5.5-ish, I think, around there. And then alternative financiers are going to be a little bit more in play for higher leverage projects. They're kind of be 12, 48 months. They'll be looking for bridge construction, some value add. They'll do some mezzanine and pref equity. So loan to cost on those is going to be 85% combined with, a pref equity or mezzanine slug in there too. And they can close within 30 days. So the sponsor profile they're looking for is folks that are executing value add, recapitalizations, and then bridge to perm strategies. But they've been very, very aggressive with their pricing and ability to execute. And those are going to be firms here in town, but a lot more national that are coming in to get a foothold on some projects we have here in Colorado. I can give some more feedback on traditional lenders or Lifeco, or do you have any specific questions I guess I can share or offer?
Yeah, I'm not sure how to open it up to, anybody have questions, you can drop it in the Q&A. I don't know if you see that. Ian Nichols said, seems like 65% loan to cost is back too. I don't know, Ian, which asset class you're referring to there, but
Yeah.
Are you seeing loan to cost kind of creep up?
Would it be good just to give kind of a high level
A retail and multi.
of what even just like, pricing in terms, amortization, loan to cost, debt service, kind of how quickly they can close, and sponsor profiles for each? Or I want to be as helpful as I can. So
yeah, maybe for like retail and multi.
Retail and multifamily projects. Can you just give me kind of like some parameters, right? So like retail, is it stabilized? Is it value add? Are we building it? Like what? Because there's going to be just different nuance within each.
Yeah, stabilized strip center.
Stabilized strip center. I mean, we would look at it both ways, right? Like, so the first one on the traditional side, I mean, we're assuming that it's going to minimally hit a 125 debt service coverage ratio, right? And so terms and amortization, I mean, kind of your traditional lenders will do between 3 and 10 years, 20 to 30 year amortizations. They can policy is a max out at 75%. For commercial, although you're not able to actually get those sized based on the debt service coverage ratio. They'll close within, 60 days. But sponsor profile, they're wanting people that have strong local market knowledge, clear exit strategy, and reasonable leverage expectations, right? Those are being priced on the traditional side, like I said, 220 to probably 280, depending on like the location and the tenant type, right? If it's more mom and pop, or if it's going to be something a little bit more like regional credit.
Cool. And then multi, he was saying 100 to 200 units in a larger metro. So like say Denver.
I mean, is this going to be, I assume again, also it's stabilized project. I mean, is that going to be an agency lift? Right. I mean,
assume stabilized agency.
I mean, if you go on the agency rip, the agency side obviously going to be like, a 30-year amortization is going to be basic. You can get a little bit more, maybe potentially a 35-year on the agency side with a few years interest only, non-recourse, right? Pricing on those. I mean, if it is actually core Denver, and we've had some agency that was like 120, 125, 130 over. And again, I'm just pricing on like, kind of 5-year stuff. I mean, they can do a lot of different terms, but for the sake of our call.
Yeah.
Is that helpful?
Yeah, that's great. I appreciate that. Anything else that we should be aware of or thinking about?
I mean, the most important thing is to let everybody know that like capital of all sorts, whether it be traditional or alternative or Lifeco or CMB, like everybody's open and ready for business, right? We're getting a lot of strong, aggressive terms from some folks that we hadn't seen in quite some time. So just for whatever it's worth to the overall like market, it doesn't feel like credit is tightening right now. There's more folks that are reasonable and looking for ways to get deals done rather than, maybe how it was last year, finding ways to not get deals done.
Got it. That's good. It's good to hear. Haven't heard that in a long time.
Yeah.
So,
Happy to share it.
cool. Well, yeah, thanks for joining. Thanks for sharing. All right. Yeah, appreciate it, man. Feel free to everybody feel free to reach out to Adam if you have any questions or debt.
Yeah. And I'm happy even with anybody here, if you're looking for me just to kind of size something out or give a few like, different lifts on what things could look like on each, I'm happy to do so. Whatever I can do to help get deals done. Somebody's got to stir the economy. Might as well be us.
That's right. That's right. I'm going to shift to Larry Holt. And I think I just made him a presenter. Go. See if that works. There we go. Hey, Larry. Hey, you're on mute, I think. Let me see.
How's it going?
Yeah. Good. How you doing?
Good. Do you have
Thanks for joining.
Alex Merrill here as well?
I don't see him on the. I don't see him on here.
Well, then it's just me, and I'll get going. So, good morning, good afternoon, everyone, depending on where you are. I'm in Southern California, and I'm with Creed, and I'm going to talk a little bit about who we are and what we do today. So, Creed started as a developer about 22 years ago, and like a lot of developers would go do a project and then lay off a bunch of really smart project managers. And so the idea was, well, what if we had a construction management side of the business? Today, that's the largest part of the company. So we fill a niche for developers that don't really want to bring on an internal construction team, family offices, private equity, and we're hired to go and develop, manage developments across the U.S. And of course, we talk to a lot of people, and what I hear a lot is, well, we know a construction manager, but they're not in Florida, or they're not in Texas, or they're not in Utah. And so we have this national platform. I've mentioned a few of the markets we serve. Obviously, headquartered in Irvine, offices in Phoenix, Salt Lake, DFW, Miami, and DC. So you might think of us as covering the I-5, I-35, and I-95 corridors, if you will. And we manage all asset classes. I tell people we've done everything from data center. We did a data center relocation for the National Cancer Institute in Maryland, which is a pretty high-tech project, to we do industrial in the Valley all the time, and self-storage in Orange County. So that's a little bit about what we do. I'm going to dive a little bit more into that and kind of give you a little bit of insight into what that looks like. So we're brought on as part of the pre-construction process. We'll do highest and best use, issue RFPs, and then what I think is important here is we just show up as part of the project budget. So we're just a percentage item on that overall project budget. Your staffing costs don't go up, and we also do because I'm sure y'all know developers that are very married to their brand. So we'll do white label services as well as part of that construction process where all the billing, all the scheduling, all the invoicing goes out under the developer's name. So, that's where we've kind of responded to the market and feel like we have a robust platform. So I've covered a little bit about where we work. Our core administration team is based here in Southern California. We have national asset class specialists though. So for instance, our national hospitality specialist who's lived his life in the hotel industry is based out of Phoenix. Our national mixed use leader is based here in Southern California, on and on. And so those project managers out in the field, asset class specialists, and admin close to home. I talked about smaller developers, and I'm sure that's kind of intuitive for everyone. Two guys with acquisitions, smarts, and capital. But we also do a lot of work for institutional, for family offices, for insurance companies, and then we even work with bigger developers that you might have heard of. So, for instance, we're currently working with Lincoln Property and Colliers, or just to name a couple, where perhaps they have 6 things kicking off in Dallas, but need something to get started in Salt Lake. And I think that highlights something else we can do, which is kind of that staff augmentation role. And we can just plug and play into a project and kick that off. So my final point that I'd like to share is just a notable addition to our team. So last year we acquired Murrow Development Consultants, and that's created a lot of excitement internally for us because they're a horizontal team. They do transportation alignment, dry utility coordination, foundation grading analysis. And while we've always managed the vertical piece and the ground up very well, we've always felt like this was something that was missing. And so now we can really kind of come in really in that early due diligence phase and supervise those pre-con services and take that project all the way to CO. And that's given us a head count of over 200 nationally. So that's a bit about Creed and who we are, and maybe even our ideal customers and some of the work we do. Val, thank you so much for having me today.
Yeah, thanks for coming on. So the size of project, is there kind of an ideal range for y'all? Is it, do you do better with larger projects?
We tell our prospects, I guess, that 10 million is the number where it kind of starts to make sense to, because as I'm sure construction is where a lot of things can go wrong in a great investment. And so, yeah, usually, in that $2 to $5 million, just retail refresh range, your GC can probably manage that, but certainly above 10 million is where we see a real value add. And another thing I didn't cover is we generally tell people we're like 3% of the overall hard and soft costs. Sometimes on a really big project or multiple locations, that number will go as low as 1%. And on a higher, more complex site, that number can skew up to even 4%. But we feel like 3% is a good rule of thumb just to share with people.
Yeah. Cool. Yeah, thanks for joining. Let me see if there's any questions. Drop in the Q&A. But yeah, no, thanks for coming on. And yeah, so we'll share the links to get in contact with you. But yeah, anybody needs help or guidance or quotes or feedback on a construction project, development project, feel free to reach out to Larry.
Thank you.
Yeah, thanks for joining. All right, cool. Let's see. I think next is Sean. Let me make you the presenter. If you want that. Takes a minute to. There we go. Hey, Sean, how are you? See, hold on, I can't hear you yet. Are you muted? There you go.
Mute. Can you hear me
Yeah.
now? Okay, cool.
Yeah, we're good. We're good.
Good.
How's it going?
Excellent, man. Excellent. And Val, thanks for inviting me onto the platform. It's really interesting, and I can see there's a lot of interesting guys. There's a guy I would chat to about DCs, the data centers, and a few other bits and bobs. Anyway, just to give you a little bit of update on what we're busy with. So, as per our last discussion, we're developing Bravo resorts and hotels, with the first one being in Bocas del Toro, Panama. So there we've acquired 23 acres of land. And as an update, actually, which is quite interesting, what we've done is we're busy in the process now of subdividing out about a hectare of the property, hectare and a half, to introduce a scarlet macaw sanctuary. And the purpose of it, actually, it's kind of it forms part of our overall marketing, and it allows for what we've done. We've created like an impact fund for that, and bringing in capital into that through what we call donor advised funds. I don't know if you guys have ever come across the DAF. So basically what it is, it allows for people to do tax, basically a tax deduction and push money into the donor advised fund. It's being administered by a group out of Texas called lohas.org. And so essentially for international stuff like that, they would then act as intermediary, and then funding would work for folk who want to essentially be part and parcel of a sanctuary. One of our colleagues is actually in a blue, it's called a Blue Ocean conference in Monte Carlo. It's starting end of this month, and very much that focus is on putting capital to work in these types of ventures. And we happen to be right adjacent to one of the largest marine sanctuaries in the world. So that, which is kind of interesting, and it's part of the ethos of what we're trying to achieve at Bravo. So that's kind of, as an update, is very interesting, and I can send you guys more information about the donor advised funding opportunities there. The other piece of it, which is also interesting, is kind of, as we've been moving our way along in the process, so we've been getting more and more interest in terms of the brand and the development of the brand. And so we've engaged, there's a company that got hold of us out of the Middle East, out of Dubai. They're sitting on a boatload of cash, like $1 billion or $2 billion or whatever. Anyways, so we're looking to, and they were asking us about, what would it take to, expand the brand into different locations. They have one particular one in Saudi, in Riyadh. And then a couple more that we're looking at, specifically in Panama, another one on the Pacific Ocean side. So that's early stage discussions, but it's an all equity fund. And what we would do strategically is partner with the fund to, advance the projects, but we would have for each project a big debt component. So we're not assuming that we'd be all equity and roll. It would be a piece of equity and debt financing for each transaction as we advance. So, that's where we are right now. I'll be in Panama pretty much most of June. We're moving forward with our entitlements there. So we're doing that subdivision, we're getting site development plan approvals, and all the kind of construction docs, set. And we've just signed up with our general contractor, Apollo Group, who will be actually essentially building it on a design build basis. Part of the deal is we do have 7, because we had to drop one of our private residences. So we had 8, we're now down to 7. And of the 7, we've got interest now in 2 of them so far without even launching. One of the groups is called Il Mazon, which is a group out of New York that is, what they're looking to do is to actually have their own, almost like branded residence. So it'll be Il Maison at Brava, and they will then own and operate it as a their own private residence for their customers and for what they want to do. And there's another group that's also expressed interest. Also, again, it's kind of these vacation groups that are out there that acquire the real estate and then they put them onto their platform for rental. So, which is actually not bad because, you know, one house, for example, is maybe between $3.5 to $4 million, but they'll be achieving, you know, upwards of $6,000 a day, you know, at sort of peak time. And that's one of the reasons why each unit is actually built as a 6 ensuite, almost like a mini hotel, aside from the resort piece of it. And so that's becoming quite an interesting next step in terms of our evolution. So we'll just keep you guys posted as we move along, but it's going in the right direction. And as I said, we're looking to expand the brand as well. So well, keep pushing.
Very cool. Yeah,
Yeah.
that's awesome. Thanks for joining. Yeah, and
That's a
feel free to
pleasure.
send anything like any
I will.
or updates.
Yeah, I'll send the details on the donor advice fund as well, because it's actually quite an interesting way in which people can participate in this type of a venture through the nonprofit side of things as well. So that's actually pretty cool.
Interesting. Okay. Yeah, great.
Cool.
Thank you.
Pleasure.
All right, let's move on to Gannon and David. Presenter. Hey, David. Hey, you're muted, I think. There you go.
Hello, Val. Very nice to meet you.
Good to meet you. Yeah, thanks for joining us.
Absolutely. And I believe Gannon should be here as well somewhere.
Yeah, I think, let's see. He should be popping in here. I'm trying to add him. There we go. There you go. I think you're muted, Gannon. Yeah, I think it automatically mutes you. There you go.
So, thanks, Val.
Yeah.
Energy.
How y'all doing?
Hey, real good. Thank you. How are you?
Good. And, remind me, where are you guys based?
We're based in Mesa, Arizona.
I got you. Okay, cool.
Yeah, we are a fully vertically integrated real estate investment and development company called Streamline, and led by David Rizak, who's our co-founder and CEO. I'll let him say a few words, and then I'll jump into some numbers here.
Thank you, Gannon. Appreciate that. Val, again, thank you very much for hosting us today. This has been very informational. Love to hear from other people in the industry. I am David Rizak, the CEO and co-founder of the Streamline Companies, a truly vertically integrated organization of real estate investment, construction and development, and property management. With over 29 years of experience in the field, I've started out as a broker, property manager, worked my way into investing and developing for our own portfolio. And right now we're on a mission to help others achieve long-term wealth through real estate investments on a passive side. With that, I'll turn it over to Gannon and let him explain exactly what we're doing.
Thank you so much, David. Yeah, to David's point, we are a fully vertically integrated company, meaning we have acquisitions, asset management, property management, legal, all under one roof, which is extremely attractive to us and our investors. It leads to economies of scale. We control the entire value chain, so we can offer better returns to our investors. We are focused on value add medical office assets and healthcare assets in the Phoenix Metro. We enjoy investing in commercial real estate for all of the other reasons that most people do: cash flow, tax advantages, appreciation, principal debt pay down by our tenants. And what we have done is launched a Reg D 506C fund, which is an exemption that allows us to raise money, syndicate deals, and go in and buy bigger assets. So currently we're in the process of raising $15 million through our fund for accredited investors, and we are investing in our own backyard. We have a very strong buy-side network here locally, which means David gets to underwrite. Well, we all collectively underwrite, but David is the final decision maker. And we get to basically cherry pick the best deals that we are confident will perform. We have a proven strategy for coming in and addressing capital improvements, deferred maintenance, and anything aesthetically that can help us to increase rents, as well as put streamlined asset management in place and improve operations, cut costs, and effectively drive net operating income, which is how commercial real estate is valued. So I'm at any point happy to jump on follow-up calls or provide decks that relate to our fund and to our first targeted property within the fund. But just real briefly to talk on numbers, we have a targeted IRR of 15+%, an 8% preferred return with an 80-20 split, meaning 80% of the profits on that promote go to our investor base, and they are paid that 8% preferred return before us as the general partner receives anything. And our typical hold time is 60 months. If we can execute the business plan before that, then we will certainly do that. We have a $50,000 minimum investment amount. And this is completely passive investing for our investors. Our database is white labeled concierge, white glove service, meaning that when you invest with us, you can log on to your own personalized portal at any point. You can track the progress of your investment. You can call us. And when you invest with Streamline, you own the actual real estate itself. So you get a K1 at the end of the year, meaning that you get to participate in the tax advantages, unlike when you invest in a traditional REIT where you just own a piece of this company that owns the real estate. With us, for example, on the last deal we did, our investors, for every $100,000 they invested, they received a $70,000 paper loss at the end of the year. They didn't lose $70,000, but they were able to use that paper loss to offset other income as they were eligible per their CPA. So with that being said, we do have a very strong targeted asset that is not under contract at this point, but soon to be. It's Parkwood Professional Plaza, which we plan to rebrand to Uptown Medical Center. And it's a 74,000 square foot office space with some seller distress. There is owner financing available, which makes it even more appealing for our investors. Definitely a deal sweetener there. And our acquisition price is about $105 a square foot, well below the replacement costs of, somewhere between $150 to $180 dollars per square foot. So we've got some really great deals. We've got some great momentum, and we love working with business owners, entrepreneurs, pro athletes, physicians, and we have an open door policy. So at any point you can call or text David or I, and we would welcome any conversations. David, did I miss anything there that you'd like to fill in the gaps?
Again, and you hit every point perfectly. We love to treat our investors as family. So please come join the Streamline family with us. Let us help you streamline your capital into long-term wealth.
Hey guys, question from Ian. So you'd love to hear about the LP equity considerations and what people are hearing from their LPs. What are you guys hearing from your LPs just in terms of current offerings and just, economic concerns or?
Well, I'll say one thing real quick, and then I'll let David share his opinion. I think right now most people are concerned about protecting their downside, right? So they're concerned about their return of capital, followed closely by the return on capital. So what we like to do is be very mindful of that, and we buy what we feel are recession-resistant assets. That's why we are focused on medical office assets. Part of our strategy is moving these from modified gross leases or something that is more tenant-friendly to triple net leases, which is very advantageous for a landlord. What that means is that people say, well, I want to invest in something with certainty, like a triple net Starbucks or a triple net Chick-fil-A. Well, we have the ability to have similar types of leases, long-term guaranteed lease structures, but instead of one lease, we'll have 10 or 20 leases all staggered with different termination dates, expiration dates throughout the deal. So we were able to negotiate with those operators and physicians who end up investing a lot of their own capital in the tenant improvements themselves. So that's one thing that I would say that's top of mind right now is people want stability and predictability, which we provide.
And then,
Val, to build on that point, to complement what Ian said earlier in the webinar, there has been a lot of volatility from investors of a rapid amount of deals and then no deals, and then starting to see some movement again. I agree with that 100%. With the April 2nd tariff war that started, everybody lost a bunch of money in the stock market. Well, that money has all come back now, relatively. And now we're telling people this is the time to diversify that portfolio, get off that roller coaster ride of the stock market, get it into an alternative asset like real estate. Our properties did not decrease in value after April 2nd. In fact, we increased our value because leases renewed at higher rates. New tenants came in at higher rates. So we didn't receive that volatility that the stock market did. And we're just trying to help people understand that and diversify their portfolio.
Yeah, that makes sense. And then another question for me, and why'd you all go 506C instead of 506B?
But I'll let you go ahead and field that.
Sure. For 23 years, all I did was 506B. So I decided to challenge myself, challenge my team to open up this onto a national market. We now have investors across the country that we weren't able to attract prior to. 506B does not allow us to advertise, only allows us to do business with people that we know and have done business with before. So by going to the 506C, it opens our markets across the country, allows us to utilize our marketing skills, and just we're able to help more people through a 506C because we can advertise across the country.
So 506B is restricted to people that you know, that you've worked with.
Correct.
C,
Friends and family. Yeah.
Got it. Okay.
506B, you need to have a pre-existing relationship, which really isn't defined by the SEC. Most people say 3 touches, but there's gray area there. But for a Reg D 506C, when David's making his rounds on the podcast circuit, he can talk about, Streamline Investment Group Fund 3. We can talk about it here. We can post about it on LinkedIn. We can do paid ads. We can do a lot of different stuff. The only caveat is that the investors in a 506C require accreditation.
Got it. Okay. So do you have to, do you all have to kind of vet them when they come in, or how do you confirm that accreditation, or do
Yeah,
they
it's a pretty simple process. When they go into the portal, we have a third-party company that helps us do it, or they can do it through their own CPA.
Cool. Great. Well, yeah, thanks for jumping on, presenting. Very cool. If y'all have a leave behind that you can send me, like a PDF on your fund, latest fund, or whatever it is you all want us to put out there, let me know, or shoot it over.
Absolutely will. I'll send that to you, Val.
Great. Sounds good. Well, yeah, thank you everybody for joining. Awesome having everyone on, and yeah, any follow-up questions, feel free to send an email out, or follow up with me directly, and yeah, I'll send out the contact info for everybody that presented, so y'all connect. Great. Have a good one. Thank you all.
Thank you, Val. Bye-bye.
Thank you. See you.
Bye-bye.